Ladies and gentlemen, we are back with the last chapter with the last part, whatever it is, of chapter 4. Finally. And what are we talking about? I mentioned it in the previous video already that now we are talking about the applicable diversification rules and all kind of rules specifically to SIFs, RAIFs, and UCAFs, and so on. So we start with the SIF. What again is the SIF? Well, it's the Specialized Investment Fund. And what the heck is a Specialized Investment Fund? Well, it's a specialized investment fund whereby, thereby nothing is explained. So let us have a look on something that actually explains it. So where to find applicable diversification rules about SIFs? As always in an CSSF circular, this time number 7309. And then we ask ourselves like, yeah, but wasn't the SIF also a regime that was established in 2007? Yes, it was. It is. And so how was it called again? So what is applicable in general terms? And in general terms, the SIF is bound to the law of the 13th February 2007. This is the law I mentioned just a moment ago, the 2007 law. All right, so what is standing in this law? And there's standing, of course, a lot in it. But what we have a look at right now is the Article 1. And there it is standing in the first bullet point, the exclusive the exclusive object of which is the collective investment of their funds in assets in order to spread the investment risks and to ensure for the investors the benefit of the results of the management of their assets. And I definitely need glasses if I continue reading these kind of small letters, because right now that I'm reading, they are like super small, not like the size you will have. All right, so, but I read it to you for a reason. And the reason is that there is standing in it in order to spread the investment risks. So that sounds like diversification rules. And then now we can have a closer look to where to find what does that mean. What does in order to spread the investment risks mean? Because otherwise we can just make up something and try to go with it. So no, we can't do that. We look in the CSSF circular if it is appearing. Yes, it is appearing. And in this very CSSF circular, we see it is called risk spreading in the context of specialized investment funds, SIFs. And there it is standing, among other things, the following, the exact definitions. And we will see it now here, but therefore I need to move, and here we go. So, in general, DCSSF considers that the risk spreading principle is complied with where the investment restrictions of a SIF, adhere to the following guidelines. Number 1. In principle, an SIF, may not invest more than 30%. We know this kind of rule. May not invest, may not more than invest in. How was it? It's always one asset, the same issuer or the same type of assets. That's what we know already, and usually it's the 20% rule. So SIF, take care, don't get confused, it's 30%. So this is the first key fact to remember. So it may not exceed 30% of the investment into a security of the same type or the same issuer. But of course, there are exemptions, and the number one, or actually the exemption is 2, is when this is not applicable. This 30% rule is not applicable when, in case it is from the OECD or EU. We know already that phrase. So when it is issued or guaranteed by an OECD member state, or its regional or local authorities, or by EU, regional or global supranational institutions and bodies. So this is nothing to memorize. Of course, if you want to, you can memorize this sentence because it's applicable to all these kind of rules. There's always this exception most of the time. I think always. I think I've seen that in everything until now. All right, that's number one. Number two is up to 30% short positions. So the investment may not exceed 30% in holding a short position in securities of the same type issued by the same issuer, of course, as well. And number three, FDIs, financial derivative instruments, and counterparty risk need to have a similar risk spread than the SIF itself. So yeah, I mean, this is self-explaining, I think. So every financial derivative instrument that is used need to apply to a similar risk spread than the SIF, meaning not exceeding 30%. This is actually it about the applicable diversification rules for the SIFs. Nothing too complicated until now. And actually, yes, this is actually really it. I mean, if you're interested, you can of course read more about the SIF situation by just reading through the 2007 law, or you can read through the whole circular, which is not that big, it's only 3 pages, so this is maybe something you can do. And of course, I guess you won't. So just remember, up to 30% same type or same issuer securities. Remember that 30% short positions, and generally everything else, and that means financial derivative instruments and counterparty risk, also 30%. Similar risk spread. A similar risk spread means actually it needs to be coherent with the risk spread of the SIF, and the risk spread of the SIF is mentioning the other 2 points. So this is quite easy. Remember these 3 things, and remember it's not applicable like it was also with the ones before, in case it's from OECD and EU and all that, or it is risk spread SIF. I forgot to mention that. If it is the investment target, it is, where's the laser pointer? Where is the fine laser pointer? Here it is. Here it is. Here. Investments in target UCITS that are subject to risk spreading requirements at least comparable to those applicable to SIFs. Actually, this then means the same than the FDIs plus counterparty risk need to have a similar risk spread than as the SIF itself. So we are done already with the SIF. Let's have a look at the next slide at the RAIF. Alright, and here we are with the RAIFs and the applicable diversification rules. But the word rules is behind the video. I'm very sorry about that. So what are the applicable diversification rules? In general, what are rules? What are rules? No, what I wanted to say is like, what are the applicable rules? Where do we find the applicable rules for RAIFs? Yes, correct. It is in the RAIF law. And the RAIF law is from 2016, as we know. On the 26th of July 2016. Well, there we do find everything regarding the RAIFs, and of course then we will find there as well the diversification rules. Let's see. So what is standing in there? Chapter 1, Article 1, the first overview. Where's the laser pointer here? Okay, we see what actually qualifies is point A as an alternative investment fund under the amended law of the 12th July 2013 on alternative investment fund managers. And B, it is stated as well, the spreading of the investment risks, and as well some other stuff. So for example, the well-informed investor. So actually what we will have a look at is a risk spreading and what is a well-informed, or otherwise called sophisticated, investor in comparison to a not well-informed investor. Maybe, I guess it's not called like this, but this would be the opposite. So therefore I move again to the other side. So now we will have a look at the risk situation, the risk spreading. Where do we find information about the risk spreading? Well, the RAIFs are applicable to the Directive 2011/61/EU. And what is actually, what is that directive? What is it about? And this directive is actually the AIFMD. So the directive of the Alternative Investment Fund Managers Directive. So of the Alternative Investment Fund Managers, the directive. And there it is stated in Article 3, because it was not like, it's not like just opening the law of 2016 to have a look at the RAIFs. No, because the law of 2016 then links you to the directive. The directive links you. It's always a little bit a linking game. But Directive 3, Article 3 of the mentioned directive says, recent difficulties in financial markets have underlined that many AIFM strategies are vulnerable to some or several important risks in relation to investors, other market participants, and markets. In order to provide comprehensive and common arrangements for supervision, it is necessary to establish a framework capable of addressing those risks, taking into account the diverse range of investment strategies and techniques employed by AIFMs. Well, so this is actually the reason why this directive is existing. And this directive then links you, no, actually the 2016 law links you to the 2010 law, and there more precisely into Article 42. Why Article 42? Well, we still wanted to know about the risk spreading. So in Article 42, we know already Article 42 a little bit, and we know Article 43 already. Actually, of Part 1 of the 2010 law. Well, in Article 42, the first sentence is stated: a management company having its registered office in Luxembourg shall employ a risk management process, which enables it to monitor and measure at any time the risk of the positions and their contribution to the overall risk profile of the portfolio of a UCITS. So we are talking about UCITS. I mentioned it's Part 1. In particular, it shall not solely or mechanistically rely on credit ratings issued by credit rating agencies defined in Article 3(1)(b) of Regulation 1060/2009 of the European Parliament and of the Council of the 16th, and so on and so on. It must employ a process, accurate and independent assessment of the value of OTC derivatives, so over-the-counter derivatives. It shall communicate to the CSF regularly in accordance with the detailed rules the latter shall define. The types of derivative instruments and underlying risks, the quantitative limits, and the methods which are chosen in order to estimate the risks associated with the transactions in derivative instruments regarding each managed UCITS. So this is it about the risk spreading. So then if one asks, what does that mean? Then one has to have a look into several other regulations, and as well as we know into MiFID II, because this actually gives a lot of not insights, it states actually the risk rules which are applicable to AIFs. And because the RAIF is considered an AIF, yeah, then one has to investigate a little bit. All right. This actually is the 2010 law, part 1, article 42. And what else do we find there? Well, we find a lot of things, but that is for later. Now we will have a look at what is a well-informed investor. A well-informed investor is mentioned in Article 2 of the 2016 law. Within the meaning of this law, a well-informed investor shall be an institutional investor, a professional investor, or any other investor who meets the following conditions. A. He has stated in writing that he adheres to the status of a well-informed investor. And additionally, he invests a minimum of 125,000 euros in the reserved alternative investment fund. That does not mean that you can just write on a paper that you are a well-informed investor and just throw your money, 125,000 in an alternative investment fund. No, that is not actually the case. This writing that adheres the status of a well-informed investor is bound to some regulatory stuff. But we won't go now into that, because otherwise it's like rabbit holes for each of these topics and we will never come to an end. But of course this will be addressed in another chapter in which this is more dealt with, so to say. Good. So then another thing in Article 8 is stated of the 2016 RAIF law that this needs to be managed. I mean, the RAIF needs to be managed by an investment company. Of course, like this is generally the case, we know that it is only not the case in case it's an FCP. Yes, and actually, in which forms an RAIF can be structured? As a SICAV with variable capital or as an FCP. So, but then the FCP, as we know generally, needs to appoint a management company because it has no legal, it has no rights, it has no legal personality, it cannot act. It's not existing. No, of course it is existing, but it has no legal. Well, it cannot. It's not a legal entity. Thereby, it needs investment company. That, of course, is in Luxembourg. Well, then maybe I should also put the structure down. So FCP and SICAV, this is applicable here, but as well, then of course, everything that is applicable to the SICAV regulation is then applicable, and as well with the FCP, meaning that, for example, in Article 20 of the 2016 law, it's also stated in case it's an FCP, so as a UCITS, then we remember also 1.25 million euros are, just 1.25 million, are necessary to, or better to say, it is stated, may not be less than 1.25 million euros. And then, of course, these rules then were stating like in which time frame that has to be reached. This amount are also applicable. And the same then counts for the SICAV with variable capital. In Chapter 3 of the 2016 law, in Article 23, then there's actually there is stated in Article 23 which kind of forms, or which kind of this reserves alternative investment fund, that is an RAIF, can be then, how it can be structured. And it can be structured as we know already about the forms of structuring a fund, as a public limited company, a partnership limited by shares, a common limited partnership, a special limited partnership, this is the SCP, and or a limited company, or a cooperative in the form of a public limited company. Well, and the articles of incorporation or the partnership agreement of which provide that the amount of the capital shall at all times be equal to the net asset value of the company, which is clear. Well, but it is also then, of course, stated in another article that I did not put in my smart list here, that of course then for the SICAV the same is applicable. You remember we need 300,000, we just need 300,000 euros to run a fund, but within the first month in the specific given period of time, we need to have 1.25 million euros as the FCP as well within the first 6 months. So that is it actually about the RAIF diversification rules, and actually it's not much stated here about diversification rules. So my suggestion for the next version of EY's reference book is to maybe put some diversification rules in it, because actually here are not much diversification rules to find. This is more just like general applicable rules for RAIFs. Well, so I think thereby the risk diversification rules and risk spreading and well-informed investor, and basically the main things about RAIFs, which we somehow know already for quite a while, are herewith explained. So we can continue with the next topic and with the next slide. And while this has been only a second for you, for me it was several days until I continue. But still I know what we are talking about, and we are talking now about securitization regulation of self-managed UCITS. I have to add, because it is standing actually here on the slide. So I think we did not talk about securitization that much yet, but we can do it now. So what is securitization? Securitization is the concept of securitizing pools into, of mortgages, of whatever kind of securities, into a backed security. So to say, one is pooling many securities into another security. Then it has many benefits, for example, risk diversification, and it opens the market wider, one can put it out of the balance sheet, and many other things. And this securitization, better to say the pooling of assets, and in the beginning it was mortgage-backed securities. That was the start of this securitization movement. And that was in the end of the 1960s, I think, or 1970. That was mortgage-backed securities, and it was firstly done by the rumor is that Lewis Ranieri, that's the name, I had to look it up on my smart notes here, and a former bond trader at Salomon Brothers, is accredited with this idea of pioneering the idea of securitization pools of mortgages. And then, as I mentioned, the first MBS transaction was in 1970. Here it is. I actually put it there, and it was done by Ginny May. Never can pronounce that. Ginny May. But then the financial, like the commercial financial institutions such as Salomon Brothers or Bear Stearns and so on, they were significantly making use of this technique and therefore it was then widespread in the 80s and 90s for their benefits. Well, and actually they became one of the most widely traded fixed income securities. Of course, it's a fixed income security, for it is pooling fixed income securities, then it is as well a fixed income security in the end what comes out. Not in case it is, yeah, well, also if it is a synthetic version of an SVP, it would be a fixed income version. Yes, because it's just mirroring it. And yeah, good that I talked about it. And why did they do that? Well, because it's freeing capital. So if one imagines a bank, and the bank has like many loans, and now the bank has to, I mean, it cannot use the money of these loans. So therefore, it is a good idea to pool it together, so then it can sell these backed securities again to the market. Thereby, they can, well, free, how I said it, capital. Good idea, isn't it? And then the rating agencies, of course, they have to rate these securities with AAA, for example. That was the case in 2000, in all the 2000s until 2007, which then, well, led to some problems, I guess. All right, so I think that is it about why, the history, so to say, of the securitization regulation. So, well, just remember it started with MBS. MBS is mortgage-backed securities. And there are also other forms of backed securities, and we will have a look at that right now. So what are we actually talking about? I mentioned it now already. And where do we find information about that? Because we always want to find information about that. And we find it in the regulation 2017-2402. I think it's actually called the securitization regulation from 2017. Well, yes, of course, from 2017, because it is also standing here. All right, so we will actually just have a look inside, because this is actually quite nice to read. And of course, I will provide you some entertaining design performance of, how you say, just have a look. Securitization, first paragraph. Securitization involves transactions that enable a lender or creditor, typically a credit institution or a corporation, to refinance a set of loans, exposures or receivables, such as residential loans, auto loans or leases, consumer loans, credit cards, or trade receivables, by transforming them into tradable securities. This is actually what is shown down here. So the lender, a credit institution, for example, has some loans, A and B, and the lender is just pooling it into a tradable security. And let's continue reading. Where were we? Tradable securities. The lender pools and repackages a portfolio of its loans and organizes them into different risk categories for different investors, thus giving investors access to investments in loans and other exposures to which they normally would not have direct access. Returns to investors are generated from the cash flow of the underlying loans. Okay, just let me catch up here. So the tradable security, which then was pooled by these loans of the lender, then will be divided into different tranches by their risk profile. For example, here in this case, I chose the credit card, ABS, so asset-backed security. There are also many others, like, I don't know if it was even mentioned here, I don't think so. But there's also factoring ABS. Factoring ABS, what's that? That is also yeah, it's also an ABS. It's not an MBS, and that is, for example, factoring. If you buy some, Klarna as a payment provider, for example, which is working with exactly that. You buy something and you don't pay it immediately, like instantly, but you pay it in within 14 days or within 30 days or whatever. And this really short-term payments which you have to conduct to not pay more, they can be factored, meaning this is they are existing, so they can be sold also then to a factorer, and the factorer is pooling them into securities, and then it is actually the same, like just that it is more liquid. Of course, also there you then have the different risk profiles and the different tranches and so on, just to explain the factoring. I don't know. I don't think it was standing in it. No. Well, however, we chose the credit card ABS risk as an example, and then we do have investor A. Tranche 1 is AAA rated, so really the most safe, and tranche 2 is AA, and this is for investor B, maybe due to their investment policies, investment styles, strategies, and so on. And the return, why the investor is actually investing into these tradable securities, into these ABS, well, because the cash flows of the underlying assets then is the return for the investors. And that actually is everything. All that is related to the financial crisis of 2007 and 2008, because of if the underlying assets, so we do have the underlying assets here, AB, and if they are not performing well, and they are packed and pooled here in a tradable security in different tranches, and then, this is not just two, regularly it's like hundreds, thousands of these loans packed together, sometimes like 100,000s of loans, and they are packed together, and if then the underlying assets are not performing well, so actually the loans, and in case of 2007, 2008, this was about the MBS, so the mortgage-backed loans, then one has a problem, especially if one uses a lot of leverage to actually buy these tradable securities. Why that? Because if you use a lot of leverage for buying a security which will pay itself back, so to say, and the return rate is lower or below the actual leverage interest rate, then this is of course not a good situation for investors. They won't be happy. And this is actually what happened in the financial crisis, and therefore, well, many people had to lose their homes because investors were not happy. Well, it feels a little bit unfair to say it that way, but actually this was what happened. There happened a lot of way more things, but this is one part of it, and one very important part. I put a small overview here in it. This is actually from the SIFMA security. I have to look it up later, and this I really have to look it up. SIF, I don't know, security in. I'm sorry, I forgot the abbreviation for that. And here in these two charts, we see the US securitization outstanding and the European securitization outstanding for the SPVs, so the specialized purpose vehicles. That's actually the short for SPV. And a specialized purpose vehicle is, for example, an ABS, or all the other things which are mentioned here. For example, CDOs. I mentioned them already before. I think CDOs are credit debt obligations. Then the other ones like CMBS is the commercial real estate loans, which then are not the mortgage backed, but it's commercial real estate loans and so on. I mean, like, these are all SPVs, and SPVs are a vehicle of investing, for example, for family wealth offices, for example. Well, but what does all that actually mean? We see until 2007 here, or 2008 in Europe, is a little bit delayed, so to say. We have a development of outstanding securities that is kind of upwards, and in the US market as well. And then here it don't decline that much like in Europe, but it also declines. And we do see as well here no, they don't have that actually. Yes, they have it, ABS here, the green ones. So actually, the green ones. This green thing includes, for example, also credit card ABS. And we see that they did decline as well a little bit. In general, the volume of the market was going down, but especially in the European securitization market, the outstanding number was going down, and we see in billion euros it is like, well, 500 billion, like 550 billion euros of less securitizations outstanding, meaning many of them maybe were default. Therefore, there are not that many then outstanding anymore. Well, so this is actually what happens when one uses a lot of leverage in these securitizations, in the purchasing these securitizations. Well, I just wanted to put that additionally on it, just to have an overview. It's always good to know more, but actually we are not talking now about MBS or anything. We are talking only about the ABS. Well, so asset-backed securities, like credit card ABS or factoring ABS, or everything else that was mentioned here. Residential loans, they were actually also there. Consumer loans, credit cards, receivables. Yes. All right, so how do we continue? We still have to know more about, because we just read the first paragraph, so let's continue reading. All right, so let's continue reading through the first paragraphs. Maybe just let me put a little bit order here. First, yeah, well, yeah, well, now I'm gone. That was not the order I meant, but I should be. Yeah, I'm back. All right, so second paragraph. In its communication of the 26th, why do we read that actually? Well, because it's quite nice to know about it, because it's the history of all that securitization regulation, or at least a little bit. So one understands why the heck do we have a securitization regulation from 2017. In its communication of the 26th of November 2014 on an investment plan for Europe, the Commission announced its intention to restart high-quality securitization markets. Well, as we have seen in the last chart, that these securitization markets were like 25% decreasing, so it's understandable that they want to, well, relaunch this market again without repeating, that's good at least, the mistakes made before the 2008 financial crisis. The development of a simple, transparent and standardized securitization market constitutes a building block of the Capital Market Union (CMU) and contributes to the Commission's priority objective of supporting job creation and a return to sustainable growth. Paragraph 2. So now we are continuing, of course, with paragraph 3. The Union aims to strengthen the legislative framework implemented after the financial crisis to address the risk inherent in highly complex, opaque, and risky securitizations It is essential to ensure that rules are adopted to better differentiate simple, transparent, and standardized products from complex, opaque, and risky instruments, and to apply more risk-sensitive prudential framework. All right, until now, it's more or less just text. So let's have a look what is standing in paragraph 4. Here we will see now the benefits and the risks of these securitizations and actually why they need to be regulated by this directive. All right, securitization is an important element of well-functioning financial markets. Soundly structured securitization is an important channel for diversifying funding sources and allocating risk more widely within the union financial system. It allows for a broader distribution of financial sector risk. I hope I still catch up here. Yes, allocating risk more widely in the union, that's where we were. It allows for a broader distribution of financial sector risk and can help free up originators' balance sheets to allow for further lending to the economy. Overall, yes, balance sheets. Overall, it can improve efficiencies, it's again super small, in the financial system and provide additional investment opportunities. As I mentioned before, of course, when one pools all that into a transferable security and then one can sell it again, so then of course it frees the balance sheet. One has again the possibility I forgot what I wanted to say. I even forgot what I was reading. So a broader distribution of financial sector. We just continued. This did not happen, and it can help free up originators' balance sheets. I think I read that already, to allow for further lending to the economy. Of course, that's what I mean. That's what I wanted to point out. Overall, it can improve efficiencies. I've read that already in the financial system and provide additional investment opportunities. Well, I don't have Alzheimer's, it is super small to read it. Securitization can create a bridge between credit institutions, allows further lending. That was the point stated before. Can create a bridge. This is actually not a bridge, but the bridge is here between institutions and capital markets with an indirect benefit for businesses and citizens through, for example, less expensive loans and business financing and credits for immovable property and credit cards. Nevertheless, this regulation, so this is actually now the benefits that they list for securitization, and that's why they are important in a market actually like for the consumer, so to say, only that maybe financing and taking credit will be less expensive, or the loans will be less expensive actually, in the best case maybe. So these are the benefits of securitization for a market. Then of course we do have also some risks, and I think they will appear directly in my face. Yes. And the risk. Nevertheless, this regulation recognizes the risks of increased interconnectedness and of excessive leverage that securitization raises and enhances the macroprudential supervision by competent authorities of a financial institution participation in the securitization market, as well as the macroprudential oversight of that market by the European Systemic Risk Board, ESRB, established by regulation, whatever, of the European Parliament and of the Council, and by the national competent and designated authorities for macroprudential instruments. Well, I will need glasses somewhere. So the risks: excessive use of leverage, as I think I mentioned that already in the slide before. If the underlying asset then is not performing well, this will develop into losses, into a loss scenario, into a bad scenario. In the worst case, of course, it can be that then this causes even the SVP to be insolvent. The risk mitigation, as stated here in paragraph 4, will be on a supranational level, will be conducted by the ESRB, the European Systemic Risk Board. That was also mentioned, I think, in chapter 3. This is located in the ECB in Frankfurt in Germany. And then on a national basis, we do have like the CSSF, ACPR in France, and the BaFin in Germany. So, for example, and of course all the other ones as well, all the other national authorities. Well, even though I'm now behind these things here, these, how do you call these things? Like these designs, these shapes. I just wanted to give an example for SVPs, for example. An example for SVPs, for example. Now I wanted to give an example for SPVs. I do say the whole time SVP. No, it's SPV, is it? Yes. Specialized. How was it? SVP. No, it's wrong here. I'm actually super tired today. I shouldn't record when I'm super tired. About using SVP. So, no, and then by using an SPV. So it's an SPV. SVP, however it is, you know what I mean, the specialized vehicle. Well, but the example is correct. So we do have the European Investment Bank in Luxembourg. And the European Investment Bank, I just want to explain how these vehicles are used and what's the benefit of it. And this European Investment Bank wants to invest into renewable energy projects within Europe. That's a good thing. And therefore, it creates a portfolio of loans. And then it will just transfer this portfolio of loans to the European Energy, the EEE Efficiency Fund, as a SIF. We know that form already. And this is then held by this EEE fund, the portfolio of the EIB. EIB, yes, correct, European Investment Bank. And the European Energy Efficiency Fund is then only charging admin fees to the European Investment Bank. And what does the European Investment Bank win thereby? Well, it is reducing regulatory capital requirements as the loans have been transferred off its balance sheet. That's actually true, I wanted to say, but of course it's true. Well, so thereby it is reducing regulatory capital requirements. Diversification, funding sources, for example, as well, as the bonds can be sold to a wide range of investors due to the portfolio is transferred to the fund, and supporting the development of renewable energy projects by providing a source of financing. Meanwhile, investors benefit from the ability to invest in portfolio of loans made to renewable energy projects, which may offer attractive returns and help support the transition to a low carbon economy. This is not a commercial for the European Investment Bank, even though it may sound like it. It is actually not. Well, I wanted to give an example for SPVs, specialized. I want to say the whole time specialized power vehicle, but this makes absolutely no sense. I may have to excuse myself. It's it's like almost 3 in the night, and I just wanted to take time to produce these two slides for you today. So forgive me if I may not explain everything in the, actually you don't see me correctly, in the regular manner. With the next slide it will be better.